Good afternoon. I'm Chance Barnett, CEO of CrowdFunder. I'm going to talk to you a bit about the current market and the future scenario, of crowdfunding. I'm the CEO and co-founder of CrowdFunder. I have some experience as an entrepreneur and investor. That's part of why I started the company. But I also got involved in a legislative and policy initiative in Washington, D.C., in mid and late 2011, which was a small group of people influential around a portion of the laws, including the Jobs Act. So what I'm going to share with you, what I think there's interesting corollaries in the market and what's happening with the blockchain and Bitcoin to what we've seen in crowdfunding. So I want to share some of those. I see interesting technologies disruption happening. I see regulatory and policy barriers and opportunities that exist that are very similar. And then there's also social barriers in the way. And I think that's a big thing. Part of what we're just hearing from the Gift CEO, there's adoption both industrial and consumer. So that's what we've been seeing in the crowdfunding market. What's driving a lot of this? Well, first of all, there's an amazing startup culture. That's part of why we're here in the room right now. It's really a renaissance at this moment. I feel very fortunate to be alive in this time where you don't need permission to be an entrepreneur and start a great company or to build on an incredible stack of technology that's been built by 20 years of innovation, and now you get to stand on the shoulder of those giants, one of which is now the blockchain. That wasn't possible 6, 7, 8 years ago. So we're seeing an explosion of innovation happening, but I mostly just want to show interesting figures to try and wake you guys up. Is that okay? I'll just do that. Okay. Some really interesting numbers that I think about. Around 28 million small businesses and startups in the US alone. 560,000 new every month. Staggering level of desire for entrepreneurship. Of course, all of those aren't successful businesses over time. This was 2013 census data, by the way. You can look at this up publicly on the web. What is interesting is, 20, 25, 30 years ago, we used to see 60, 70, 80% of our GDP was by larger companies. Now it's about 50% of our GDP is startups and small businesses. So the makeup of innovation and our economy is changing. One of the things that's driving this change is changes in early stage and mid-stage finance. We're looking at changes in later stage finance, but I see those as less disruptive, although really, really important. Some of those changes that are happening under what we do at CrowdFunder called equity crowdfunding, which is just about investment, not like Kickstarter and Indiegogo where you can pre-purchase products or rewards in experience. We exclusively help people become shareholders and get a financial return. We have these giant existing markets that aren't just this new class of people who might or want to come on and start investing, but we're also going to be eating into these giant existing markets of finance that are already here and now being automated and brought online. That includes the $30 billion in venture investments. What happens as technology and automation helps a portion of LP capital move to more diverse, innovative, and automated venture investing models. What happens when VC investors use automation, signaling, messaging in order to find great deals? What happens to the angel market as that continues to happen? And what happens even in an interesting market where I see all of private placements moving, where investor relations used to be this entirely weird PR-driven function, and now that can be automated, that can be brought onto platforms. It's creating a lot of change. So we've seen the convergence of some really interesting movements all in one, and that's part of what's driving the innovation and the growth of crowdfunding, which I want to show you some data I think you'll find fairly surprising. But it's really automation, new policies that support this, the idea that anyone in this room can and might actually be an entrepreneur, starting a company. And then finally, what underpins a lot of this, I think, which is really core, is if I told you 10, 15 years ago that there'd be a bunch of people giving each other money on the web for ideas, you would have told me I was crazy. If I told you that was now a multi-billion-dollar industry, you would have said I'm really crazy. But now we have that happening to the tune of tens of millions of dollars on an annual basis with people who never meet. And so part of that underlies that is what we've seen in advances in the social web. LinkedIn and Facebook really help accelerate trust. They're not perfect. And part of it's just the culture of today. So that's driving it. This is 30 seconds, the industry evolution of crowdfunding. Started with charities, causes, and music, people doing interesting stuff, trying to engage their fans. It was just about purchasing experiences, things like concert tickets. And then we saw that move closer to more project-based things as we got into the 2010s. And then we removed a regulatory barrier with a portion of the Jobs Act that allows accredited investors to invest around 2012. That was implemented then. We've seen the market mature over the last 2 years for accredited investors. And that's what we really look at as kind of the 2.0 of crowdfunding. I don't know if you know this graph, but this is the industry growth of crowdfunding. This is the money that's going in, both including rewards, equity, and debt. So we see this incredible exponential growth, estimated to be roughly $90 to $100 billion by the World Bank in 2020. I think we're going to beat that if you look at the trend. $34 billion estimated by the end of this year. Pretty fascinating. Here's my favorite chart. And I'm talking about myself in the third person here. You can see it on Forbes. The blue line is crowdfunding as a whole, everything all in, equity, debt, rewards. The green line is angel capital, and the red line is VC dollars. So at the end of 2015, we're going to see crowdfunding as an alternative finance source surpass venture capital. Who knew that about a trend? Yeah, so this is growing really, really rapidly, and it's changing how people can and should think about financing a business. There's historical precedence for this, by the way, of radical change being brought by relatively simple policy implementation. In 1978, there was something called the Pension Reform Act, and a specific few lines in there, literally a few sentences, called the Prudent Man Rule. And this affected pension fund managers who manage billions, and allowed them to no longer be liable for any single investment in their portfolio, but for the portfolio as a whole. Long story short, what that did, it allowed them to start investing in high-risk funds. Guess what those were? Venture capital funds. That single change gave birth to the modern venture capital industry, which was, in 1977, an estimated $39 million in formalized funds. Few years later, $6 billion, just 4 years later in venture capital. Arguably responsible for the largest wave of innovation and GDP growth at any one time in our history of the world. We wouldn't have Intel, we wouldn't have Apple, we wouldn't have incredible companies if it wasn't for small policy change like this, that's just a few sentences. So we're seeing that today with the Jobs Act. We're changing the face of early stage finance and bringing it online by allowing it to be automated and have online distribution. That's part of what I worked on. My co-founder, Ray First over there, arguably a bigger Bitcoin investor and a blockchain guru than I am. But we teamed up in roughly 2011, 2012, and worked on stuff on Capitol Hill. Right now we have the ability for any accredited investor to invest in deals. We don't have the ability for a really easy workable system for startups, for non-accredited investors to invest in early stage startups that are private. But that's likely coming, although we do have something called Regulation A+, which is really kind of a mini IPO, not very workable for startups based on the amount of compliance, timing, and cost. But some people are working on it, and it is a route. So as I think about the future of crowdfunding, one of the questions I think deeply about and work to solve at CrowdFunder is what happens when investing in entrepreneurship is really something that moves entirely online. It can happen for as little as, say, $500 or $1,000, which is really the reality of what you're starting to see today. How does that change the nature of investing in entrepreneurs? Gross promotional moment here, that's what we do at CrowdFunder. We've done over $100 million into the companies on our platform, roughly the last 4 quarters, building a large network of individual, institutional, and accredited investors that are institutional and individual. So just to draw a really fine point, because some people even grab me after I present sometimes and ask me, so how are you different than Kickstarter? Here's a Kickstarter campaign that raised $6.2 million. Neil Young's Pono music player. 15,000 people pre-purchased it through Kickstarter. For them and their brand, a great validation of the product, identified a need and opportunity for audiophiles in the market, pre-sold their items. Then they came to CrowdFunder because they wanted to raise equity and they wanted an additional 5 to 6 million to finance additional inventory and grow the business. That's what we do at CrowdFunder. We help them take in that $5 million round. We had about $10.2 million in interest in about 10 days. So we run both a private and a public platform that is exclusively for investment. Here's a really interesting slide. Right now there's about 15,000 public equities on the stock market, and we see about a 10% average IRR if you're an investor money in those. And there's really interesting tried models, say mutual funds, of diversifying and making that a low-risk, easily accessible asset class for you as an everyday person to invest in. My question to you is, why doesn't that exist for venture investing? Why do you have to be a rich LP in order to get portfolio access to the startups in this room? Why can't you do that? Well, there's actually many millions of private equities, and if you could invest in the last 30 years in every single startup that got funded at the seed stage, you would have gotten a 27.8% return on your money. So that's in part the future of crowdfunding that we're building at CrowdFunder, is not only how do you invest in great companies that you might know, believe in, or you love the lead investors, the angels that are leading that, but how do you invest portfolio across this as an asset class? And so there's going to be, and there are interesting models that create more of a mutual fund or index. And I'm excited for that to be a way for people to buy into that asset class, support entrepreneurship, but not do it at the same level of risk that you see angel investors or VCs investing oftentimes with other people's money. So I'll take a few questions. There's probably some relationships you might be curious about or opportunities with the blockchain. And I think I've seen a few people trying to start dedicated sites for crowdfunding around Bitcoin and the blockchain, but haven't seen any scale to date. So I'll take some questions here. Any questions? Right here. There are opportunities like that in vehicles that already exist. So if you could have something on the public market, it is accessible to an unlimited number of LPs, quote unquote, and non-accredited investors. So there are fund models that you can use on the public markets. What I think is difficult is creating the amount of scale in order to help them invest into the private companies. And it's connecting those two things that's a challenge, but I think a platform is a good way to solve that. Another question? Right there. Hi. Across private equity funds, no. We're building an index model that'll, at scale, allocate across 3,000 or so deals per year at scale. Right now, it's over several hundred deals, and so that's growing over time. We see about 500 to 800 new deals organically come on our platform on a monthly basis. So we're starting to see that level of scale. What we like to see is this crowdsourced vetting and sourcing and vetting of those deals. So it's oftentimes validated on a both quantitative basis and on a correlative basis to achieve that kind of scale, because you're not going to do it trying to traditionally vet and pick winners. The return is 27.8% IRR. Yeah. Yeah. But I rounded it to 30 just because it looks better. Great. Any other questions? All right. Thanks for your time.